Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas. I teach intermediate accounting 1 and 2. And today's lecture, I'm going to work problems for long-term assets for depreciation expense using 3 different methods. This is easy stuff. Even my principles of accounting students have to know these 3 methods. And so I'm sure this is doable. And for my UNT students, this is the very end of intermediate accounting 1, and they will proceed on to intermediate accounting 2 as their next course. So good luck. I'm going to get started working here. I want to give credit, as I always do, to McGraw-Hill using Spice, Lynn Nelson, and Thomas textbook called Intermediate Accounting. These are my problems for the most part here. So with that, I'm going to share my screen, and I got to work. I got to work now so that you guys can work when game day comes. You know what game day is, hopefully. That is the exam day. So, all right. So we're looking at these problems here. XL delivery company purchased a delivery van. And so what do we care about? 3 things. What's the depreciable cost, that we've got to allocate over the service life, which is the second thing we got to know. And then we got to know our method. Well, they're going to ask us, it's an accounting problem, to do straight line, double declining, and units of production. And so let's just get started. Definitely going to go for straight line first here. Well, let's do this. I'm going to put, it asks for the expense each year. And so let's do right at the top, 2021, 2022, 2023, 2024, 2025. And we got the straight line. If I can write here, I'll just abbreviate that, straight line. And I've got double declining method. And I've got the units of production. What are our units here in this example? Well, it's a vehicle, so I imagine miles. Oh yeah, expected miles to be driven 100,000. So here's an activity-based measure. So the service life is 100,000 miles, not in terms of years or anything like that. Now, let's start with the straight line. Straight line, I've got depreciable cost, 33,000 minus 3,000. 30,000. And again, I talked about in a previous lecture, what's the real cost for our business? Well, we got to pay 33,000 up front. Hey, but we're not going to put our head in the sand. We know we're going to get 3,000 back later when we sell it. So the real cost is 30,000. Now the cost, we're going to use this for 5 years. So we need to spread this and allocate this to each of the 5 years. So this is about allocating to the accounting periods, years. Straight line, 30,000. And we're doing this per year, divided by useful life or service life, 5 years, 6,000 per year. Easy stuff here. And that's why most companies, for financial reporting purposes, use the straight line method. They'll use these, the accelerated method, other accelerated methods allowed by the IRS, and the double declining method for tax purposes, because we get earlier deductions. Let's see how that works. Now, double declining takes a little bit more work. So I'm going to put some columns here: net book value, rate, and let's see, depreciation expense, and accumulated depreciation, running balance, and we're going to need this net book value every year to do the double declining. So let's just go 21. What's our net book value at the beginning? It's this is we use the net book value from the preceding year. What's the net book value preceding year? It's what we bought it for. It's the 33,000. And again, this is the one method that we ignore the residual value until the end, because why do I say the end? I don't care what method you use, you never expense in total more than the 30,000 because that's our cost. These changes in method is just on how much we're going to allocate to each year. What's the rate here? Okay, the double declining rate, the single, the straight line method was 1 divided by 5. So 2 divided by 5, it makes sense. Double declining. The straight line was be 1/5. That's what we use here. 30,000 times 1/5 equals 6,000. In the double declining, we use 2/5 or 40%, if you will. And we start with the net book value. So for year one, we ignore the residual value. What's 2/5 of 33,000? 13,200. So what's our journal entry? It would be debit depreciation expense, credit the contra asset, accumulated depreciation. This is our first entry for accumulated depreciation in for this particular asset. And now we have a net book, a new net book value, right? Which is going to be 33,000 minus 13,200 or 19,800. So 2022, we use the end of the year, preceding year's net book value, 19,800 times 2/5. So 2/5 of 19,800 or 40% of 19,800, 7,920. Now, when we credit debit depreciation expense and credit accumulated depreciation, now we're going to have a new balance, 13,200 plus the 7,920, 20,120. And we have a new net book value now, which is the 33,000 in our vehicle account minus the accumulated depreciation of 21,120. Now we have 11,880. 23, 11,880 times 2/5. Just kind of grunt work now, and this is getting down to some more math. $4,752. Debit depreciation expense, credit accumulated depreciation. Now we have a balance in here, 21,120 plus 4,752, 25,872. Now we're going to keep an eye on this because we cannot let this account go greater than 30,000. We're still under the 30,000 because we got to get to, we're going to end in the same place we ended in the straight line method with a $3,000 net book value. And so there will be a year here, not this next year, where we're going to have to plug this just to prepare you. So 33,000 minus 25,872, 7,128. 2024, 7,128 times 2/5 equals, that's 40% of that amount, 2,851. Add that credit to, this is a debit to depreciation expense, a credit to accumulated depreciation. And now we end up with 28,723. What's our net book value? 33,000 minus 28,723, 4,277. 25, 4,277 times 2/5. Let's go see what that number would be. 4277. That would be 1710. What's the problem? If we add 1710, really 1711 with rounding, 1711, 28,723 plus, that would take this to 30,433. Too much. So this is now going to be a plug. What does it take to get this to 4277? It's going to take depreciation expense of 1277, or 4277 minus the $3,000 residual value. So I told you we're still going to account for the residual value, but at the end, not in the beginning. Only method where we don't account for it at the beginning. All right. 28,723 plus 1277. I already know the answer to this. $30,000. And this, we end up in the same place we ended up in the straight line method, where we took $30,000 of expenses. Here, if we add all these up, 30,000. All right, 13,200, 7,920, 4,752, 2,851, and 1,277. Now, the total depreciation expense under both of these methods is $30,000. But in an accelerated method, double declining, we take more expense up front. That's why the tax department loves this method, because they get larger tax deductions up front and cash savings on cash taxes paid. And now they're going to pay more taxes out here, but that's in the future. So from a time value of money standpoint, better to get big tax deductions now. Financial reporting department may continue to do $6,000 per month. And that's what most of them do. All right. Units of production. So again, here we do account for the residual value, 33,000 minus 3,000. We've got a $30,000 cost for 100,000 miles. So how much is each mile costing us? That would be 100,000 divided by $30,000. No, I'm sorry, I'm doing it the wrong way. How much would 1 mile cost us? We just take $30,000 cost divided by 100,000 miles, or 30 cents. So for every mile we drive, we're going to record 30 cents. Let's just see how much we used it for. If I go to the problem, 22,000, 24,000, 15,000, and 20,000, and 21,000. That's just year 1, 2, 3, 4, and 5. So 22,000 times 30 cents, 6,600. 24,000 times 30 cents, 7,200. 15,000 times 30 cents, 4,500. And we look at that. We use it less this year. We expense it less. I do love this method. And as I said in my last lecture, in the lecture for this chapter, the problem is trying to capture all this data for all of our assets in a very large corporation. That would be a challenge. But man, what a good method to use. 20,000 times 30 cents, 6,000. And 21,000 times 30 cents. We're gonna have to look at this. That is 6,000. Let's just see how much that would be. 6,300. Now let's just do a check. Let's add these all up. 6,600. 7,200. We're checking because we don't want to do more than $30,000 in costs. At this point, total is 24,300. 300. Adding all of these numbers, I'm at 24,300 in accumulated depreciation, just adding the first 4 years up. If I add 6,300 to that, I can see right off the bat, wow, that's going to be too much depreciation because I cannot do more than 30,000. Therefore, I'm going to take 30,000 minus the 24,300. And so that last year is going to be 5,700. Let's just put these up here. 6,600, 7,200, 4,500, 6,000, and 5,700. So if you're working on a problem on an exam, it's good to just double check your work there. I'm going to go double check mine. 6,600 plus 7,200 plus 4,500 plus 6,000, 30,000. And so here's a method that really completely, is directly associated with usage of the vehicle. And so you can see how depreciation, there's a little bit more volatility there. And I would come back and say, hey, straight line is a better reflection of actual usage than certainly double declining. So we want to have faithful representation in our financial statements. Go back to chapter 1 in concepts of accounting. So would certainly vote for straight line if I was having a hard time capturing all of that data. And then this, doesn't really reflect reality, but if the tax authorities allow me to do that, I'm going to do that for tax purposes, because that's just about following the IRS regulations. Financial reporting, we're thinking about the users of the financial statement, not the government, and what the government allows us to do. We're trying to reflect reality. This seems like a better reflection of reality than the double declining method. All right. Let's do problem number 2. Okay, now we have a $100,000 van and 10,000 residual value, expected miles to be driven, 50,000. We have the same 5-year useful life, so again, I'm going to do this a lot faster than I did last time because you've already seen this now, and I'll probably do less talking. So straight line equals, again, use the residual value, 100,000 minus 10,000 equals 90,000. That's the actual cost over 5 years. So each year's cost, 90,000 divided by 5. See, 90,000. $18,000. Just checking my work. I don't want to screw up here on national TV. if anyone ever watches it, I hope my students do at least. So 18,000. Now, double declining method. We're going to have to do, it's hard to get away from using columns for this. So net book value, beginning of the year, rate, depreciation expense, accumulated depreciation, and I'll start abbreviation now, and then net book value. So starting net book value is 100,000. Again, ignoring residual value because that's not part of the net book value. The rate is 1 divided by 5 times 2, or 2/5, or 40%, whichever. Now keep in mind, because we're on all these examples, and then maybe even a third example, I only do 5 years. But if this was a 10-year, 1 divided by 10, double declining will be 2 divided by 10, 20%. So, I think I probably in these problems used 5 years because you're going to be bored stiff if I go through all 10 years. I should have done some at 3 years maybe. So depreciation expense is 40% times beginning of the year net book value, 100,000, $40,000 first year. So there's my balance in accumulated depreciation. And my net book value now 60,000 end of the year. Year two, 60,000 times 40%, 24,000. 24,000. I got a new credit in the accumulated depreciation is 64,000. My net book value is my $100,000 original cost minus how much I've depreciated, 64,000, 36,000. Year three. Again, you should practice these so that when you get to the exam, you're going at, I would say super speed because you want to go methodical, but you have so much confidence, you know what you're doing because you've done it at home. Football players don't go to the game and without having practice. They would just be totally destroyed. They wouldn't know what the plays were. They would just be destroyed. And that's what happens to some students who show up for an exam unprepared. They just get crushed. Hate to see it. It's much better to spend time and effort studying than to get crushed in an exam. There's no reason for it, really. So 40% times 36,000, 14,400. Add that to 64,000, and now I got 78,400. Remember, I wanted to stop when I get to 90,000, so I got to keep an eye on that. But I'm okay right now, 21,600. And I could stop. It didn't have to be in the last year. I could get there in the third year, as we saw in the textbook example. So now I got year four, 21,600 times 40%, 8,640, 78,400 plus 8,640 for accumulated depreciation equals 87. It's 86, 87,040. Net book value 100,000 minus 87,440, 12,960. I'm only 2,960 away from my residual value, so I almost know 12,960. %, would be 5184, way too much. So now what am I doing? I'm plugging. What number X will make this equal to 90,000 in this? I know my final answer in year 5, 90,000 and 10,000. So what do I need there? I need, looks like 2,960. And there you go. Accelerated, a lot more depreciation in the earlier years than the later years, compared to this, which is 18,000 every year. And keep in mind, 18,000 times 5, 90,000. So we get to the same place. All right, let's do units of production method. I have a 100,000, a $90,000 cost, right? Because we are going to take into account the residual value in this method. That's the real cost. And we're going to divide that by the number of miles we expect to drive, 50,000 miles in this case. So each mile is costing us 90,000 divided by 50,000, $1.80. All right. How many miles we're going to use it for? 5,000 first year, 10,000 second year, 20,000 third year, 5,000 fourth year, 15,000 in the fifth year, and these are all times $1.80. $9,000. 18,000, 36,000. Let's keep a running total over here for accumulated depreciation so that we know when we get there. 9,000, that would be 27,000. 27,000 plus 36,000, 63,000, because I got to stop when I get to 90,000 here. So that's why I'm checking this. So 5,000 times $1.80, I already know that answer from up above. 9,000. And now I'm at 72,000. So I know my next year cannot be more than 18,000. I use it 15,000 times $1.80, 27,000. I cannot do 27,000. I can only do 18,000. Why? I cannot get to more than 90,000 because my net book value right now is 100,000 minus accumulated depreciation of 90,000 equals 10,000. That's what I expect to sell it for. So I stop. I can't depreciate below zero. That would be recording way too much expense because this van cost us 90,000 over 5 years. We can't have depreciation expense greater than what it cost us. And so we stop here at the $90,000 accumulated depreciation, just like we did in double declining. So in double declining and units of production, you got to keep an eye on this, especially if you're in my class and working an exam problem. In my class, we'll have to do all three of these methods on an exam. I think the exam's too easy, right? I know maybe some students from other universities let me know about it, but it's almost like too easy, like a free 15 points, because these are so simple. All right, last one, and we'll call it a day or an evening for me. So we now have a $200,000 van, residual value of 40,000, expected miles to be driven 80,000. And so, and it's going to be 5 years. Again, I use 5 years because I didn't want to have to, write out 10 years of work here, make it easier for myself and then an exam problem. It'll be something, maybe that 3 to 5 years. So straight line. Okay. Again, so easy. I get what's my cost that really costed me. I got paid 200,000 up front, but I get 40,000 back at the end of 5 years. So my real cost is 160,000. Straight line, 160,000, same cost every year, divided by 5 is 32,000 per year. Double declining. Let's go back, get our columns in here. Net book value, rate, depreciation expense, accumulated depreciation, end of the year net book value. So we start with a 200,000. Residual value has nothing to do with our net book value. And so in this method, we always start with net book value times double the straight line rate. So the straight line rate was 1/5 or 20%. So our rate for double 5-year rate is 40%. 40% times 200,000, that's easy math, 80,000. First year, accumulated depreciation is 80,000. Beginning of the year, net book value 200,000 minus 80,000, net book value is 120,000. I should say not beginning of the year, that would change every time. What is the historical cost of that that's sitting in the delivery van account is going to say 200,000. Well, the second account, a contra asset account, with a credit balance of 80. So 200 minus whatever's in this account, that equals the net book value. Year two, 120,000 times 40%, 48,000. Credit accumulated depreciation, 128,000, 200,000 equipment vehicle account minus the contra asset, 128,000, and I got now a 72,000 net book value. End of the year, same as the beginning of the year, times 40%, 72,000 times 40%, 28,800. Now add that to our 128,000. Now we got 156,800. That's 120,000 plus 28,800. And our net book value is 200,000 minus 156,800, 43,200. Now, what are we trying to get to? We're trying to get this account to 40,000. We're going to have to stop when we get to 40,000. So year four, I got 43,200 times 40%. I've got 17,280. Well, that's going to show me way over that, because I'm really close to the 160,000 now. So that's 17,280 is too much. I'm just going to have to do 3,200. And that takes that to 160,000. And my net book value is the same as, and this is a really good example because what happens in year five? Done. I like that example. I can get done early. And so if we add all these up, all these expenses, let's just check our math, 80,000 plus 48,000. $160,000, which we know because it's total depreciation expense over those 4 years equals what we have in accumulated depreciation, 160,000. So I'm going to count it, checking my work. It's good to check your work on an exam as well. So therefore, that's a double declining. And finally, we will do the units of production method. And so we have, again, now we do use the residual value. We're looking at the total cost of the corporation, $160,000, divided by how many miles we'll use this. Let's see what miles, 80,000 miles. I think I'm going to like this because it's a nice round $2 per mile. So every time we drive that vehicle 1 mile, we're going to record depreciation expense of $2. Now we're not going to do it every mile they drive it. We'll do a journal entry probably at the end of the month or in the quarter, whatever accounting period. This one we're doing a year. So we've got 25,000 miles, 15,000 miles. I'm pulling them from the example up here. 30,000 miles. Year four, 20,000 miles. In year five, 20,000 miles. And they're all times $2. So first year, we're going to have a $50,000 depreciation expense. And I'm going to track the accumulated depreciation because I want to make sure that I don't go over the 160,000. I can't go over that cost, $200,000 cost minus what I plan to get back at the end, 40,000. So the real true cost of that vehicle delivery van is 160,000 in over 5 years. I'm just trying to allocate it per year. So I'm doing accumulated depreciation here, just like I did it up here under the double declining method. And I'm doing it so I can kind of check myself. I don't screw up here. 30,000, now I'm at 80,000. In year three, we drove it 30,000 miles times $2 a mile. 60,000. So now look at this. I'm already up to 140,000 in accumulated depreciation. And I cannot go beyond 160,000. So $2 here would be 40,000. But 40,000 is going to put me way over 180, 160. So I got to stop. I can only do, I'm capped at 20,000. And I'm done. My net book value now at the end of year 4 is 40,000, which is my residual value. So I'm done. Year 5, just like double declining, 0. Total 160,000 in depreciation expense. So you got to really track this if you're working a problem on the exam. Now, what I would say is that the original estimate was not really good because we've used this for 40, 70, 85. I think that's 100. I'll just make sure I don't get it right. We use this for 110,000 miles, where in our problem here, we said we only expected 80,000 miles. So we use this for a lot more miles than we anticipated. So it might have been better to have a different upfront assumption, and then it'd have been less than the $2. We would have been depreciated. So it's really not correct. I'm sure we used the best assumption we had at the time, but this year basically we drove this man for 20,000 miles. We had 0 expense. So it caught up with us, but we still, even then, cannot expense this van for more than the cost of 160. And that still assumes we're going to get 40,000 back at the year 5. And so again, each year we would be evaluating this and potentially, come up with a change in the estimate for the useful life for these. And we would change our accounting. Again, a change in the estimate, when we change our estimate, maybe we go ahead to 110,000 miles after year 2, and then that is a prospective change. We would change that in the out years, and we would not go back retrospectively on that. So with that, that does it for property, plant, and equipment. And I did have a lecture on intangible assets and natural resources, which we love in Texas with the oil and gas industry here. But again, I appreciate your time. And this is, again, this lecture, man, if you have an exam on this, you got to knock it out of the park, please. And then again, practice. Go back and watch the video, pause it, and when you have the problem, work it yourself. And then fast forward to get my answer and see how well you did. So again, thank you for your time, and I wish you the best.